A guy, we'll call him Mike, worked at SpaceX for 7 years. Brilliant dude. The kind of engineer who'd pull 18-hour shifts stress testing heat shields and then go home and fall asleep on his couch with his shoes still on. His reward? A $21.4 million stake in SpaceX that represents 93% of his household's investable net worth. 93% in one company, one ticker symbol. And he's not the exception. He's the average. SpaceX equity, typically granted in the form of restricted stock, represents up to 90% of many SpaceX employees' wealth. On June 12th, 2026, exactly 2 weeks ago, SpaceX went public on the NASDAQ in the largest IPO in history.
Came at 11:47 a.m. Shares of SpaceX began trading on the NASDAQ and immediately soared 11%. The stock's rise launched the net worth of founder Elon Musk, making him the world's first trillionaire. He addressed employees this morning.
I give SpaceX less than a 10% chance of succeeding at all.
At a valuation of $1, $77 trillion. The company sold 555.6 million shares, raising $75 billion. To put that in perspective, the previous record was Saudi Aramco at $29.4 billion. SpaceX surpassed that by more than 2.5 times. And it minted, by most estimates, more than 4,000 millionaires. Not just executives, but employees in roles from cafeteria workers to contract welders. Sounds like a fairy tale, right? Here's why I'm making this video. Because most of them, and I genuinely mean most, are about to watch a massive chunk of that money evaporate. Not because the stock crashes, not because SpaceX fails, but because of taxes, concentration risk, and a series of financial decisions they're gonna make in the next 90 days out of excitement, impulse, or just plain not knowing any better. And the wildest part? There's a brand new tax law that almost nobody's talking about that just changed the entire playbook for what you do when you suddenly have money. Like, the rules literally shifted under everyone's feet last July, and most people haven't caught up yet. So whether you're one of those SpaceX employees sitting on life-changing equity right now, or you're a tech worker, a doctor, a lawyer, anyone pulling six figures and thinking about building real wealth, what I'm about to walk you through applies to you directly. And by about minute 14, I'm going to show you a move involving the estate tax that's so counterintuitive, most financial advisors won't bring it up unless you specifically ask, because it doesn't make them money. Stay for that one. So here's what everyone's doing right now. They're celebrating. And look, they should be. A former welder named Juan Hernandez worked at SpaceX for 10 years, preparing rockets for takeoff, building the structures that lifted them onto the launch pad. He eventually rose through the ranks to become a supervisor. He owns 6,500 shares. On the first day of trading, his wealth ballooned by $1,046,175. A welder, a millionaire. That's the American dream in its purest form. But here's the thing nobody's saying out loud at the celebration. The stock opened at $150 and finished day one nearly 20% above its offering price of $135 per share. Everyone was euphoric. Then it hit an all-time high of $225.64 on June 16th, 4 days after IPO. People were losing their minds. And then?
All-time low, $147.11. June 23rd, 7 days later. SpaceX's 35% one-week drop erased more than $600 billion in market value. That's not a crash, that's a correction. Totally normal for a freshly public company. But you know who doesn't experience it as normal? A 31-year-old propulsion engineer in Hawthorne, California, who just watched his net worth go from $3.2 million to to $2.1 million in a week. On paper, while he's locked up and can't sell a single share. Because here's what most people outside the finance world don't know about IPOs. Musk and other insiders have agreed to not sell their shares for 366 days. Other pre-IPO investors have a 180-day lockup.
Lockup restrictions typically prevent employees from selling shares for 90 to 180 days after listing. The wealth is real on paper, but will remain illiquid for months. So you're a millionaire who can't touch the money. And the money is moving violently every single day. That's not wealth. That's a psychological hostage situation. And this is where it gets really interesting. Because the decisions these people make between now and when that lockup expires, what they plan, what they set up, what they understand about the tax code, that window right there determines whether they keep 70% of this money or 50% of it. That's not a small difference on a $3 million stake.
That's the difference between walking away with $2.1 million or $1.5 million. $600,000, decided not by the stock market, but by whether you understood the rules of the game you were playing. So let's talk about those rules. Quick question. If I said One Big Beautiful Bill Act, does that ring a bell? Probably not. Terrible name. Sounds like something you'd hear at a county fair. But it's a U.S. federal statute passed by the 119th Congress containing tax and spending policies that form the core of the current administration's agenda. Signed into law on July 4th, 2025. Now, I'm not going to walk you through every provision. There are hundreds. But I'm going to focus on the 4 or 5 that directly affect anyone sitting on a sudden pile of money right now. Whether that's SpaceX stock, RSUs from your tech job, a business you sold, or an inheritance you weren't expecting. Here's the first one, and it's the biggest. The OBBBA permanently raised the federal estate and gift tax exemption to $15 million per individual, $30 million for married couples, beginning January 1, 2026. Unlike the Tax Cuts and Jobs Act of 2017, the OBBBA contains no sunset provision, meaning this higher exemption is now a permanent feature of the tax code, unless future legislation changes it. Do you understand what that means for a SpaceX employee? Let me paint the picture. You're 34, married. You and your spouse have a combined SpaceX stake worth, let's say, $8 million. Under the old law, the one that was about to sunset, your combined exemption was about $14 million, and it was going to drop to roughly $14 million anyway in 2025, or potentially crash to $7 million each if Congress didn't act. It was chaos. Nobody knew what to plan for. Now, the unified estate and gift tax exemption is permanently increased to $15 million per individual, $30 million for married couples, with annual inflation adjustments thereafter. Your $8 million? Completely clear of federal estate tax. But here's the sneaky part most people miss. That exemption isn't just for when you die. It's for gifts, right now, while you're alive. If you previously used most of your exemption through lifetime gifts, the OBBBA's higher $15 million threshold means you likely have additional exemption capacity. Someone who gifted $12 million in 2024 when the exemption was $13.61 million now has approximately $3 million in additional lifetime exemption available. That's $3 million you can move to your kids, into a trust, into a dynasty structure, tax-free, that you couldn't move 6 months ago. And nobody sent you a letter about it. No notification, no alert from your brokerage.
You just gotta know. Now, let me hit you with the other provisions that matter, real quick. The SALT deduction cap was raised to $40,000 for taxpayers making less than $500,000. If you live in California, New York, New Jersey, Washington State, anywhere with high state taxes, this one stings or saves you, depending on where you fall. For a SpaceX engineer in Hawthorne making $180K base,
that's a meaningful difference on your return. Employees and self-employed individuals may now deduct qualified tips received in occupations listed by the IRS.
And individuals who receive qualified overtime compensation may deduct the pay that exceeds their regular rate, like the half portion of time and a half, required by the Fair Labor Standards Act. Probably doesn't apply to most engineers, but if your spouse works in hospitality, service, healthcare, tell them, like today. And here's one more that nobody talks about because it's boring. The QSBS capital gains exclusion was enhanced. A new 3-tiered graduated system replaces the old one. The minimum holding period for stock acquired after the effective date is now 3 years instead of 5. 50% exclusion at 3 years, 75% at 4, 100% at 5. And the maximum capital gains exclusion increased from $10 million to $15 million. If you own stock in a qualifying small business, not SpaceX, but maybe your side thing, your startup, your buddy's company you angel invested in, this just became massively more valuable. 3 years instead of 5 to start seeing tax-free gains. That's a big deal, and literally 0 people are making TikToks about it. Okay, so now you know the tax landscape. But here's where I need to get real with you for a second, because this is where the psychology kicks in and the math stops mattering. SpaceX equity represents up to 90% of many employees' wealth. With such heavy concentration in what will likely be a volatile stock, advisors typically counsel clients to diversify. And yet, almost nobody does it. Why? Because it feels like betrayal. Seriously, I've talked to people in this situation, not just SpaceX, but early employees at Meta, at Google, at Uber pre-IPO, and they all say the same thing. This stock is who I am. I watched this company grow. I believe in the mission. Selling feels like giving up. And I get that. Emotionally, that tracks. But financially, here's what you're really doing. You're making a single bet with 90% of everything you own on a company that posted a net loss of $4.28 billion in its most recent quarter. A company where one man holds over 82% voting control and can make decisions you have 0 say in. The governance structure concentrates economic upside broadly, but decision-making power narrowly. You're along for the ride, and the ride might be incredible. SpaceX might be worth $5 trillion in 10 years. I genuinely believe it could be. But might is not a financial plan. Might is a prayer with extra steps. Here's what kills me. A group of more than 100 current and former SpaceX employees created a low-fee wealth management arrangement with advisory firm Corio, representing combined potential wealth of between $1 billion and $5 billion. The group was formed specifically to prepare for the post-IPO liquidity event. 100 people got together, pooled their leverage, negotiated lower fees, and hired professionals. That's engineers doing what engineers do, optimizing the system. And honestly, that's brilliant. That's what smart money does. But the battle to manage the tens of billions of dollars in newly liquid wealth held by SpaceX employees is just getting started. Private banks, wirehouses, trust companies, and other registered investment advisors are all sending teams and hosting events in California, Texas, and Florida, hoping to win their business. Read that again. They're not coming to help you. They're coming to win your business. There's a difference, a huge one. And if you don't understand that difference, if you don't know what questions to ask, what fees are acceptable, what a fiduciary actually means versus someone who just sells you products, you will get eaten alive. Politely, in a nice office, with complimentary sparkling water. All right, enough doom. Let's build something. Because here's the thing. The people who win in situations like this aren't the smartest. They're the ones who act within the window. And right now, there's a window. Move 1. RSU tax timing. When your lockup expires and you sell SpaceX shares, that's a taxable event.
If your shares were granted as RSUs, you already got taxed on the fair market value at vesting. But the gain between that vesting price and your selling price, that's capital gains. And if you've held them over a year from the vesting date, that's long-term capital gains. 20% max federal, not 37%. So the literal date you sell matters. The calendar is your weapon. Don't just sell the second the lockup lifts because everyone else is. Think about what tax year you want that income in. Think about whether your other income is high this year. Think about whether Q4 or Q1 makes more sense for your specific situation. Move 2. Diversify, but intelligently. I'm not saying sell everything. I'm saying if SpaceX is 90% of your net worth, get it to 50% or 60%, something where you can sleep. Use the proceeds to build a three-legged stool, a broad market index fund for growth, a high-yield savings account or short-term treasuries for your emergency runway, and real estate, if and only if it makes sense for your life, not because some guru told you to. And if you're looking at real estate, the IPO is expected to accelerate a housing boom in South Texas, where SpaceX's Starbase launch facility is located. The average home price in Cameron County has more than doubled since SpaceX arrived, rising from approximately $131,000 in 2014 to over $281,000 in April 2026. Translation? Don't buy in your own backyard just because it feels familiar. That's doubling down, not diversifying. You already work there. Your stock is there. Your income is there. If SpaceX pulls back from Starbase, and this is aerospace, plans change. Your house, your job, and your stock all take a hit at the same time. That's correlation risk, and it's the silent killer. Move 3. The estate gifting window. This is the one I told you to stay for. The federal estate and gift tax exemption is now $15 million per individual, $30 million for married couples, effective January 1st, 2026. It's indexed for inflation starting in 2027. If you just became a SpaceX millionaire or a multimillionaire and you have kids, you can start gifting right now. The annual gift tax exclusion is $19,000 per recipient in 2026. That means you and your spouse can give $38,000 per child per year without even touching your lifetime exemption. But here's where it gets spicy. You can also set up an irrevocable trust, a SLAT, a dynasty trust, a GRAT, and move appreciating assets into it while the value is lower. If SpaceX is trading at $153 today, and you think it'll be $300 in 5 years, you gift the stock now. Use your exemption at today's value, and all the future appreciation grows outside your estate. Planning now allows families to shift appreciating assets, business interests, real estate, marketable securities, into trusts or other planning vehicles that exclude future growth from estate tax exposure. You're literally freezing the value for tax purposes while the asset keeps growing. That's not a loophole. That's the law. It's right there in the code. But your brokerage didn't send you a push notification about it, and your HR department definitely didn't mention it in onboarding. Move 4. Backdoor Roth for the high earners. If you're making over $150K, and most SpaceX engineers are, you're technically phased out of direct Roth IRA contributions. But the backdoor Roth strategy still works in 2026. You contribute to a traditional IRA, non-deductible, then convert to a Roth. The money grows tax-free forever. Why does this matter right now? Because if you're about to have a year with lower income, maybe you took a sabbatical, maybe you're between jobs, maybe your RSUs haven't vested yet, that's the year to convert. Your conversion gets taxed at your ordinary rate. Lower income, lower rate, more money stays in the Roth. This is chess, not checkers, and time
timing is everything. Move 5. Don't forget state taxes. Here's my little controversial take that I know is going to bother some people. Not all states are created equal when it comes to taxes. Texas, where SpaceX is headquartered, where Starbase is, has no state income tax. California, where a lot of SpaceX engineers still live, has a top marginal rate of 13.3%. I'm not telling you to move. That's your life, your family, your call. But I am saying, if you're sitting on $3 million in stock gains, and you live in a state with double-digit income tax, and your lockup expires in December, and you've been thinking about relocating anyway, the math is the math. That's potentially $300,000 to $400,000 in state taxes alone. Some people buy a house for that. Just know the numbers. Then do what you want. But know. Let's zoom out. The OBBBA. That stuff applies whether you have $3 million or $30,000. The scale changes, the principles don't. The system is knowable. It's not intuitive, it's not fair, but it is knowable. And once you know the rules, you stop being the player who gets played.
Now, before we get started, don't forget to subscribe